But all right, let's get started, guys. So if you're just coming in, you don't know what we're doing. Somebody asked me in Discord yesterday, which gave me an idea. They asked me, or they didn't ask me. They posted a chart, and they were drawing their fibs wrong. They were drawing their fibs from the wick, or not their fibs. Sorry, they were drawing their divergences on RSI from the wicks. And this is a common issue that I always go over with people. That you cannot draw your divergence from the wicks when you're using RSI. You just can't. It's not the proper calculation. And that gave me an idea that I wanted to make a video to go over the common mistakes that people do when they are trading RSI and MACD. So I'm going to start off with RSI. Let's pull up RSI here. I'm going to be using the default just so everybody can use the same thing. Let's make sure this thing is default. The default settings are 70-30, and then those are the colors. But okay, so first off, we're going to go over what I just talked about. The first mistake that people make when they are drawing their divergences, people love to take the wicks because it's the highest point, right? They love to take the wicks. You take the high to the high, right? And then you take your tool and you go to the RSI and you take high to high. And you're like, okay, that's a bear div. So most of the time, it is still going to be a bear div. So even though you're doing it wrong, you're getting lucky and it's working out most of the time. So if you do it like this and you're like, oh, it still works, that's fine. If that works for your trading, that's okay. But just know that you're doing it improperly, and if this ever does not work out, you're going to get hurt because you're doing it wrong. So the reason it's wrong, guys, is look at the RSI. What is the source? The source for this calculation is the close. The source is not the high, not the low, not the open, high, low, close. It's just the close. It does not take into account any of the price action besides the close, unless it's a special RSI that has a different formula that does that. But the default RSI does not take into account any of the price action besides the close. So this thing could wick to $10,000 and come back down to $5,000, and that wick would do absolutely nothing to the RSI calculation. I know that seems really crazy to you guys, that you could have an insane wick and it would not affect the RSI. But that's how it's calculated. If we go into the source code, you can see the actual calculation here. And if it's calculated off the source, or off the close, I mean, you can see that there's nothing else in the code that would allow the wick or the bodies or anything else besides the close to affect that RSI. There is nothing in the code that would allow it to do that. The only way it's going to allow it to do that is if you go in here and you change it to the wicks. Now, funny thing here is you still have a divergence on the wick to wick, high to high. It's a much smaller divergence though. But this is the accurate calculation. This would be, if you're taking the wicks, this would be the accurate way to draw it. If you're taking the close, you need to take it from the bodies. You need to take it like this. Now that is your divergence. Now the funny thing is on this doesn't really give you the divergence. You have like a double top. It still gives you a divergence if you're reading the RSI properly, because right here we're making equal highs, but we're making a much lower low, or much lower high on the RSI. So this is still a divergence, just not textbook bear divergence. So this one actually was easier to see if you use the wicks. But that's the improper way to use it because the calculation is not there. So just know that when you're using divergence on RSI, if you're using close, the proper way to draw your lines is from the bodies. If you're using like high, then you want to draw it from the wicks. If you're using low, you want to draw it from the lower wicks. Okay, so that's the first mistake. The second mistake is people love to always say that the RSI is overbought, the RSI is oversold. And they love to trade it using that signal, overbought, oversold. And what I mean by overbought, oversold, if you're not familiar with RSI, is anything above your threshold, which the standard threshold is 70. Anything above this threshold would be considered overbought, and anything below 30 would be considered oversold. So what overbought means is it's extended. It's looking, it's too extended to the upside. It's going to be looking for a pullback, or it's going to be reversing. That's what it means. Well, the way people trade it is as soon as it enters that overbought, they always think it's weak, sell it. It's going to come back down. They think it's like immediately going to reverse. That's not the case. Most of the time, I've taught this a long time ago in my stream. When you trade overbought, oversold indicators, if you trade that mentality completely backwards, so if you trade that when it's overbought, it's very strong, if that's your mentality, you're going to do much better than when it's overbought, it's very weak. And if it's oversold, it's very weak to the downside. So if you trade that opposite to the crowd mentality, you're typically going to do a lot better than, okay, it's instantly overbought, I'm going to reverse it. Or it's going to reverse, I need to trade it to the downside. No, that's not the case. Think about, what does it mean to be overbought? What does it mean to be oversold? So if something is overbought, it means that it's getting bought up a lot, right? It means it's being bought up rapidly. It means it's in a strong uptrend. If something is in a strong uptrend, why are you going to try to catch the top every chance you get? You're trading against the trend. So if you're instantly trading the overbought to the downside, if it's not at a strong resistance point, you're going to be trading against the trend. So you're going to be taking a short when it's blowing off the top or when it's breaking out to the upside. And more often than not, you're going to get killed. Okay? But if you trade it properly, and you're like, okay, the RSI is overbought, I'm going to start to look for reversal signals. This is not the reversal signal. This is the warning. So when it's in this overbought zone, it is warning you that it's extended. Look for reversal signals. It is not the signal. That's the main mistake people make. They think it's the signal. And I know because I used to trade RSI religiously. When I traded back in penny stocks and futures, I was an avid RSI and MACD trader. And I read a bunch of books on it, and I looked at all the signals, and I traded it religiously based on those signals. As soon as it was overbought or oversold, I started looking for the reversals. And I always thought it was going to reverse. And I noticed that it was basically opposite to that. So if you look at this more of a warning, like, okay, we're overbought here. All right, let me put in a level. We're overbought. We're getting overbought. I'm going to put in a level. That's going to become my support. So if we start to break that support and the RSI begins to fall, then I'll start to look for shorts. But look what it does here. It breaks out to the upside. Because that's what overbought means. Overbought means it's in a strong uptrend. Overbought means it's being bought up rapidly. Okay? So we enter this overbought range. We come back down, it pushes out of the overbought range. We're staying above the like overall RSI trend. It's another thing you can do with RSI is you can draw trend lines on RSI. It's very helpful. So we're staying above the RSI trend here. And then what do? We break out to the upside. Massive breakout. So if you shorted here, you're dead. No matter where your stop loss is, you're getting annihilated. So if you're trading this improperly, you just lost that trade. If you're trading RSI properly, and you're like, okay, it's overbought, I'm going to look for a reversal signal, or I'm going to look for an invalidation of a reversal. So you have a consolidation here. This is not a reversal signal. If you know proper price action technique, this is not a reversal signal. This is a continuation signal. Let me pull up volume. This is not a reversal signal. This is a textbook continuation signal. You have high volume on the breakout. You have low volume on the consolidation. That is a textbook bull flag. If we go down to like a 15 minute, this is a textbook flag pattern. High volume on the breakout, low volume on the continuation, high volume on the breakout. This is the most consistent textbook breakout pattern. High volume, push up. Low volume consolidation, high volume push up. So if we're trading this and we're looking at the RSI pattern and we think, oh, this is going to reverse. I'm not going to long this. It's overbought. It's going to reverse. You just lost that trade. The proper way to do it is to look at the RSI trend. Look for a signal from the price action. Price action should always be your signal. Price action should always be your signal. Remember that. Indicators should never be your signal. Like even my personal indicators, like my Momo, it gives you signals. Yes, it does give you signals for reversals or trend breakouts or whatever, bull traps, bear traps, whatever. But that should not be your signal. The price action should be your signal. That should be your warning. That's why I always try to correct myself when I'm saying, oh, here's the signal from the Momo. I'm always like, oh, no, it's actually a warning. I'm trying to correct myself because indicators should never be your signal. So the signal here would be the price breaking out of this trend and your RSI not giving you a divergence. The RSI is following price. The RSI is maintaining its trend. So we have a breakout, consolidation, RSI is staying on its uptrend, and then we see a move up. And when RSI enters that overbought, that's typically because it's a strong trend. It's typically because it's breaking out. So we see here that a breakout is occurring, and what is RSI doing? RSI is entering the overbought range. That's a pretty good sign that that's a good move up. Not that it's going to reverse. That's a pretty good sign it's a good move up. Okay. So same thing for the downside. Let's see if I can find an oversold. Let's go back to like the daily on this downtrend. Okay, so look here. When we saw that massive breakdown, let me get rid of volume. When we saw that massive breakdown from 6K down to 3K, we were basically oversold the entire time. So if you were looking for the oversold signal, which basically starts here and doesn't end until here, all of these candles are technically oversold. So if you're like, okay, we're oversold here, I'm going to be looking for, I'm going to buy it immediately. As soon as we're oversold, I'm buying it, okay? So you're buying this wick here. You're buying this move down. If you would have held this, which you should have, because this is a daily move, this little tiny move up, that's not going to hit your profit. That's not going to hit your target. So this is a daily move. You bought the move down, you're holding it. You just got destroyed. Because you think that as soon as it's oversold, it's going to reverse. So you bought here, you just got destroyed. But if we look at the same thing, let's go down to like a 4 hour. This is our daily oversold range. Let's go down to a 4 hour. So same thing like we saw on the upside. What you should be doing is, okay, we're oversold. Let's see if we can find a resistance point. Okay, we found a resistance point. Now let's see if we can break out of this resistance point. Okay. So we find the resistance. We're trying to break out of it. It never happens. We never break this resistance point. You have a few wicks, but you never close above it. So if you're properly trading the RSI, you're looking for a reversal point, you never have a reversal here. You put in a reversal, you never close. You put in a resistance, you never close above it. So if you're not closing above your resistance, you're not going to reverse. How are you going to reverse if you can't break a resistance point? You're more likely to break your support and continue downward, which you did. You broke your support, you closed below it, and you continued downward. Let's go back to a daily. Okay, so we continue downward here. We're still very, very oversold. The RSI gets all the way down to like 10. It's extremely oversold. But what does that mean? If you think about the calculation of the RSI, what does that mean? That means that price is on an extremely strong downtrend. Price is breaking into like new lows. It is destroying the longs. Why would you want to short? Why would you want to long that any chance you got? You're basically paddling against a white water rapid river. Like, yes, you should be looking for reversals because it is extremely oversold. But why would you take that oversold as your instant signal and be longing every chance you got? You're going to get stopped out immediately almost every time. Because think of the RSI as like a river. When you're extremely oversold, that river is flowing against the longs heavily. The river is flowing downward very heavily. If you're trying to take longs, you're literally paddling against a river that's flowing against you extremely strong. And same for vice versa. If it's overbought and you're trying to take shorts, you're paddling against a river, a very strong river. So look for clear reversal signals. Don't use RSI as your signal. RSI is warning you. Just think of overbought and oversold as a warning range, and then start to look for your levels. So okay, we're oversold, right? We're oversold, right? We're going to start to put in our resistance signals. Or sorry, our resistant levels. Okay? You can also look for wick patterns or candlestick patterns. Like, clearly you're finding a support here. You have 1, 2, 3, 4 lower wicks, all in the same range. This is good when you're seeing oversold. When you're seeing oversold and the price action is telling you, yes, I'm oversold, then you can start to buy that. That's beautiful. When the price action is saying it's oversold and the RSI is saying it's oversold, that's a good signal. That is your signal. The RSI is not your signal. The price action is your signal. Right? Okay, so if you're ignoring these wicks, what do we see here? We see an engulfing pattern. We see some inside bars here. 1, 2, 3 inside bars, 3 inside up. A 3 inside up is when you have inside bar, inside bar, inside bar, engulfing. Okay? So you wouldn't have entered on the close of this engulfing because you're still at a resistance point. You would have entered on the break of the engulfing. So once you started to break these 3 inside bars, that's where you would have entered. You could have taken a small trade there. The RSI is following price. The RSI is on a nice little uptrend. Right? RSI is on an uptrend. Our price action is showing that we're that were oversold. Then you see that candlestick pattern to confirm the oversold. You have the wicks, you have the doji, you have the morning star, you have the 3 inside up, whatever you want to call this. This 3 candlestick pattern, red, green, green, that is a morning star. This 4 candlestick pattern, doji, 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 engulfing, is 3 inside up. That's a reversal pattern. So you have all these signals. The price is your signal. Ignore the RSI as your signal. It's just warning you. So that is the proper way to trade that. Look for the RSI trends. Look for the price to give you the signals. Does all that make sense, guys? Do you guys have any questions about RSI before I move to MACD? So basically, overall, what I just went over, if you're just coming in, do not use RSI as your signal. Use RSI as your warning. Let price action be your signal. When you're drawing your divergences with RSI, make sure you're doing it according to the RSI source. If the RSI source is close, make sure you're taking the close of the bodies as your source for the divergence. Don't use the wicks. Wicks do not affect an RSI close. Know that when RSI is in a overbought, which is whatever your threshold is, the standard threshold is 70. Know that when it's above 70, when it's overbought, that doesn't mean it's going to instantly reverse. That means that it's actually in a strong uptrend. Same thing for oversold. It doesn't mean it's instantly going to reverse to the upside. It actually means it's in a strong downtrend. So make sure you are using price as your signal for when to take those reversals, not RSI. RSI is the warning. Price is your signal. If RSI is overbought and you start to see gravestones or shooting stars or tweezer tops or double tops, stuff like that, price action is your signal. Then RSI is overbought. Okay, that looks good. We have a high probability that we're going to reverse to the downside. Same thing for oversold. If it's oversold and you start to see piercing patterns or dragonflies or morning stars, double bottoms, triple bottoms, bullish divergence, stuff like that, that is a high probability that it's going to reverse to the upside. That is your signal. Stop using RSI as your signal and you'll stop losing trades because of it. Another thing that you can use with RSI is trends. RSI is very good to draw trend lines. I know it looks like a meme, but it's not a meme. Trend lines on RSI are very strong. You can draw price action patterns on RSI just like you can on price action. So like look what we saw here if we're drawing trend lines on the RSI. We saw basically like a rising wedge, right? You have this breakout, retest, so we break out, we're retesting. Okay, now we start to fail on the RSI. So now you start to look for reversal signals, right? And then we have a double top, which just confirms that failure when the RSI has a clear bear div. Double top, you lost all your momentum. And then what do you see? Massive failure. That is the proper way to use RSI. I don't use RSI because I prefer my Momo. But RSI is a very strong indicator if used properly. The thing about RSI is so many people use it improperly that you can basically counter trade the people that are using it improperly and you'll do quite well. So just know that a shit ton of people are just seeing that it's overbought and are instantly trying to sell it. And that's why you see this consolidation here. You have all these RSI traders being trapped. All the RSI traders that are trading improperly are being trapped here. They're taking shorts, taking shorts, taking shorts. And then you start to see that breakout, and then they all get squeezed. All those RSI traders just got annihilated. Alright, that's RSI. I'm going to move on to MACD. If you guys have any questions about RSI, just post them and I'll get back to it once I'm done with MACD. The Mac Daddy. Let me change my colors a little bit because it's kind of hard to see on a white background. So this is the default. Let's make sure it's default. Reset settings. Okay, this is the default. Let me change my colors a little bit because this is a little hard to see. Make this red. Let's make this a little darker. Not that dark. That should be good. And then let's make this like blue. And let's make this a little darker. Okay, that should be good. And let's make these lines a little bit thicker. Okay, this should be easier to go over. Okay. Another thing, so first off, if you guys don't know what the MACD does, it's basically, it takes two moving averages, ties them to a signal moving average, and then it shows you the overall trend of those moving averages, the convergence and the divergence. That's why it's called the MACD, moving average, convergence, divergence. It's showing you how far apart they are from each other, to the upside and the downside, and if they are diverging from one another. MACD is a lagging indicator. That is the number one mistake people don't understand. MACD is a lagging indicator. It's based on moving averages. Yes, it gives you very good signals, but those signals are delayed heavily. Because it's based on moving averages, price action will start to push upward or start to push downward, and those moving averages will not show that push up or down for quite some time. If it's a longer moving average, it will take longer to show that price action. So, this signal is actually quite good. This gave you the cross down right here at the high here, right? You wouldn't have actually seen this cross down until probably like around this candle. Thankfully, this double topped, and then it failed, so this was a good signal. But sometimes what you will see is, this will give you the cross down signal, right? So it will give you the cross down signal, let's say like right here, and then price will continue upward, and then you'll get kind of either a divergence or just a complete false signal, and then you'll break out and you'll lose your trade. In this instance, you see a proper cross down, double top, and then a failure. So this is a proper way to use the MACD. You see the signal, and then it never recrosses. You never have that false break. So even here, when you start to double top, you don't have that recross. It has that clean move down, and you see that bear div. So you see that higher high being formed, but the MACD is continuing downward. You can either use the histogram or the lines. I typically use the histogram. Or sorry, not the histogram, the lines. I typically use the lines. So same thing with the MACD, with the same as the RSI. People are using it more for signals. Hold on, there's a fire truck going by. People are using it more for instant signals instead of waiting for price to give you that confirmation. So like we see here is what I was just talking about on the prior one. You see this cross down right here, right? But then look what price does. Price just slowly continues higher. If you would have shorted here, you most likely would have been stopped out before the actual move down. But if you would have traded MACD properly, and you saw that clean divergence, then you start to see the reversal signals, where you see this break of the support, where you have the high being formed, the red candle, and then you break that high. That's your signal. Price action is giving you the signal, and MACD is also giving you the signal with the divergence. That's how you want to use MACD. You don't want to be using it exactly for the signals. Same thing here. You had your cross up on the MACD. If you would have taken a long here, You would have taken a long after that move up, and you would have missed the long. And you would have lost that trade. Same thing. Oops. Same thing here. If you would have taken this cross down, unless you took profit immediately. No, actually, this cross down was late, so you would have taken it down here. You would have shorted down here based on the cross down, because you can see the cross down is on this candle, right? But you always have to go a further candle, because that's the actual cross down. So here's the close, then here's the next close. So this is closing here, this is closing here. That's just connecting it. The line is just connecting those 2 points. So think about where those 2 points are. This candle's closing here, so it's closing at 21.5. This candle's closing here, so it's closing around like 19. This little point in the middle is just connecting those 2 dots. So your actual cross down is on this candle. If you would have taken the cross down on this candle, you would have shorted here. You would have only been up 0.38%. You would have had a drawdown of 1.5%. That's a terrible trade. It's a terrible trade. You basically had a 5-to-1 drawdown. So don't pay too much attention to the crosses on the MACD. The crosses are more of a warning. So think of the crosses as overbought, oversold. The same mentality. When it crosses down, that's basically telling you that it's trying to enter a bear trend here. So look for bearish reversal signals. So like right here, we're crossing down. Look for bearish reversal signals. So hopefully, if you saw this signal here, when you engulfed this candle, you would have taken a short. And you would have had a nice little short there. 1.5%. If you would have held on to it, you would have had a drawdown of about 1.8%. But if you let price tell you the story, if you let price be the signal, you would not have taken the short down here. You would have waited for that engulfing candle. Price is your signal. So the MACD is in a bearish format, not 100% bearish. 100% bearish is when the blue line is below the orange line and it's below 0. That's 100% bearish. This is bearish, but it's bearish in an uptrend. If it's above 0 and the lines are, if the fast line's below the slow line, it's bearish, but it's bearish in an uptrend. So it could be leading to consolidation, it could be leading to a pullback, but your overall trend is bullish. If the MACD lines are below 0, that means they're in a downtrend. If your fast line's above your slow line and you're below 0, like here, this means that it could be consolidation, it could be a pullback, but your overall trend is bearish. But then you see that break of the 0 line, then you start to see your break to the upside. But let's go back to what I was saying. So let price be your signal. Same with MACD. When you see the cross down, it's telling you that you're entering a consolidation phase or you're entering a pullback phase, but you don't want to short it immediately. You want to wait for price to be your signal, okay? So price is your signal here when it engulfs. Then you take your short. Same thing here. We see your cross up. Let me delete all these. Zoom in a little bit. So right here, we're above 0. So we're in an uptrend. We're crossing up. So we're entering a 100% bullish phase. So we're going to wait for our bullish signal. You're not going to enter on this candle because the cross up is not happening. That's why MACD is a great hindsight indicator. You're like, oh, there's the cross up. I'm just going to trade the cross up. Boom, big candle. Oh, I would have made money. That's not how it works. This cross up is not happening, or this big candle is not happening because of the cross up. The cross up is happening because of the big candle. Price is the leading indicator. The MACD is the lagging indicator. This is not leading price. This cross up is not leading price. It's lagging behind price. So what we see here, this cross up like I told you, this is the close of this candle, calculated at like 14.7. This is the close of this candle, calculated at around like 18. But we don't even see the cross up until the close of the next candle. So we see the close of the next candle, and it's calculated at like 19. So if you would have taken the signal here on the long, yeah, if you would have taken it right on the close, you would have been up less than 1%. If you would have held on to it, you would have had a massive drawdown. Or not a massive, but you would have had a larger drawdown than you would have had a target. But if you would have waited for that proper signal, okay, here's our resistance point. We're starting to fail. Let's wait for a break of that resistance point. Okay, the MACD is trending downward, trending downward. Okay, the MACD has a cross up here. Look what price does. Once again, it's lagging. If you would have taken the breakout of this high, you would have entered long before the MACD crossed up. If you would have entered when the MACD crossed up, you would have entered here on the close instead of on the break. Which if you would have waited for the close, you would have actually entered on the same candle. But as you can see, that's a late entry. So if you have the cross up here and you take it immediately, you get killed. You can see your massive drawdown. That's the wrong tool. You can see your massive drawdown of 2.3%. So basically all I'm saying is, same with RSI, don't use MACD as your signal. Use MACD as your warning. So what you want to see on MACD is, if you're a MACD trader, if you like using MACD, what you want to see is, okay, where is MACD? First thing you look for, is it above or below 0? Okay, we're below 0. Okay, if we're below 0, that means we're in a downtrend, right? Okay, now we want to look for, where is the slow and the fast line? What order are they in? Is the slow line above the fast line? Is the slow line below the fast line? What order are they in? The blue one is the fast line. Okay? So if we're in a downtrend, and the blue line is below the orange line, whatever colors you have, if the fast line is below the slow line, you're in a strong downtrend. If the blue line is crossing the slow line, the fast line crossing the slow line, if you're below 0, you're entering a pullback from a downtrend, but you're still in a downtrend. This can be a reversal to the upside, meaning a reversal to a new trend, an uptrend, but that doesn't happen until they cross 0. So for example, if this is the fast line and we cross the slow line, and then we cross the 0 line, which is the signal line, then you are entering an uptrend. This is an uptrend. This is not an uptrend. That is a pullback into an uptrend. So yes, you are going to see this turn into an uptrend very often. But if you take this signal as your uptrend, if you take the signal as turning into your uptrend, then you are going to get trapped. It's going to become a bull trap very often. Because you're typically going to see that happen when you're seeing moves like this, where you see like bull flags, or you see like wedges downward. But typically, this is giving you a divergence, so this is an exception. But if this was like a flagging pattern, that's bearish. Bear flags are bearish, right? But you're going to see a signal to a reversal to the upside very, very often when you have a bearish bear flag. So just know that if you take that signal as a reversal signal into a completely new trend, you're going to get faked out very often. So another proper way to use the MACD is what we're seeing currently. What are we seeing? We're seeing a new low forming. This is a pendulum low. I like these kind of lows. and you're seeing the histogram closing in. So the actual lines are not giving you a divergence, but the histogram is giving you a divergence. So there's two different ways you can do the divergence on MACD. You can use the lines or you can use the histogram. Right here, the lines are not giving you a divergence, but the histogram is. What does that mean? That means that the moving averages, the 12 and the 26, are getting closer together as this low is forming. So you're forming a lower low, but the momentum is losing strength because your fast moving average, your 12, is getting closer to your slow moving average, your 26. So because they're getting closer together, that means that you're losing momentum. So if you're forming a new low and you're losing momentum, what does that typically mean? That typically means that low is not a proper low, right? That typically means that that low is not going to be, it's not going to maintain. It's not going to stay a new low. That's how you can use the histogram. The histogram is more of a momentum. The histogram also tells you when the crosses are happening. You can see here, when the histogram crosses 0, that is your cross. So for example, right here, like I was just telling you with the histogram, it's showing you a loss of momentum, correct? So when you have these bull flag patterns, where you have that impulse and then consolidation, you see what? The histogram is increasing on the move up, and then we start to decrease on the move down. That's good. That's what you want to see. You want to see a loss of momentum when you're consolidating. And then you want to see that momentum come back in when you start to break out. Is exactly what we saw. We saw momentum on the upside, a loss of momentum on the downside, and then increase in momentum on the upside. That is what you want to see with MACD. I didn't mean to rhyme there, but I guess that's a good way to remember it. I think that's it. What are some other common mistakes? Do you guys have any other common mistakes that I didn't cover? Are there any other mistakes that you guys think that people make a lot with MACD or RSI? I think I've covered just about all of them. The overall mentality it's not just MACD and RSI, it's with every indicator. The overall mistake that people make is they use indicators for signals. And I make the mistake when I'm going over my indicators and I say this is a signal. The indicator is not giving you the signal. The price is giving you the signal. The indicator is alerting you to the signal. Every indicator is derived from price. That's how you get indicators. Indicators are calculated using price action. Or volume, or some other form of price. So why would you want to use a derivative as your signal? You don't want to use a derivative as your signal. You want to use the derivative as your warning. You want to use price as your signal. If you make that one small change in your trading, I guarantee you'll trade better. Stop using indicators as your signals. Use them as derivatives of price action, as warnings. And use the price as your signal. But alright guys, I can't think of anything else to go over. I'm going to keep this video nice and short so I can edit it and throw it on YouTube. This video was just to highlight some of the key mistakes that people make when they trade RSI and MACD, two of the probably most used indicators in trading. I think they are the most used indicators, if I'm not mistaken. Yeah, this video was to highlight the mistakes that people make and how you should be properly trading these indicators. If you guys would like me to do a video like this on another indicator, like Bollinger Bands or anything else, OBV, stuff like that, feel free to just let me know and I'll add it to the list. I'm going to be streaming every day, so I need ideas for videos. If you guys would like to see this kind of style of a video done on another indicator, just send me a message, post it in the comments on YouTube, send me a message on Discord, DM me on Twitter. There's many ways you guys can reach me. But yeah, I appreciate you guys being here. I'm going to be streaming tomorrow. What's tomorrow? Thursday? Yeah, tomorrow's Thursday. I will be streaming late on Thursday because my Tuesdays and Thursdays are late streams. It will probably be an analysis stream. So if you guys want to stop by for that, I'll be streaming probably around 7 or 8 o'clock, same time frame. Moving averages, yeah, that's a good one. That's a good one. I'll probably do that. Probably Friday or Saturday. I can do that. Bollinger Bands, I can do that. We'll do them at the same time because Bollinger Bands are basically the same as moving averages. Yeah, next stream, I'll do the proper way to use Bollinger Bands, the proper way to use moving averages. I like that idea. All right, guys, that topic will probably be covered on Friday or Saturday or Sunday. Any of my days that are not short days. Sunday's actually a short day, so probably Friday or Saturday. But yeah, appreciate you guys being here. If you're on Twitch, hit that follow button if you haven't already. Appreciate all the support on Twitch, all the subscribers, all the bits, the donations, everything. You guys are insane. If you're on YouTube, hit that subscribe button and post in the comments if you guys would like me to cover another topic. And I will catch you guys next time. Peace out, guys.